life is the only contract that guarantees your cash value must rise every single year. The only question is how fast.
And you have the death benefit, illness riders, tax benefits. When you add all of those and you get bond-like returns, do you have a problem with people calling it a better bond?
When I think of my personal planning, I'm 100% equities, real estate, my own business, and then whole life. I don't own a single bond fund. I probably never will, because I'm going to have hundreds of thousands, maybe millions in whole life cash value that is today rising at over 5% net of all the mortality and expense. Like, why would I even consider bonds if I can get, a tax-free north of 5?
Let's talk about IUL. It's interesting with the whole Kyle Busch deal. It's definitely made waves.
In order for you to believe that IUL is going to outperform whole life over the long term, which effectively is getting that same 5% in the general investment account, you have to believe that call option spread is reliably going to get you 6 or 7 or more forever. And you don't think that the smartest minds on Wall Street, if they could find a predictable way to get 5% into 6 or 7, they wouldn't be leveraging trillions of dollars, borrowing every dollar they could from around the globe to do that? They're not.
Tom Wall, you're a friend of the channel. Welcome back.
Great to be with you again, Caleb.
There is a lot for us to chat about. We have the Kyle Busch deal. We have dividend season. Obviously, you have a growing whole life mastermind. I would just love to kind of get insights on some of the topics that you guys are learning. I also, if we have time allows, I'm building a life insurance internal value calculator that I would love to run by you in real time, just to get your thoughts on it. And if you think that we're being misleading in some areas or some areas that we can be that can be enhanced. So with all that, with all the news, with all the exciting things going on in the insurance space, tell me where your headspace is at, and what have been some of the conversations that you find yourself having recently and just in the space. And I also know that you have an event coming up that I would also love for us to plug, and to anyone watching, if you're watching this before January, there's a must attend event, and I definitely want the details and to be below for that.
Awesome. Yeah. Gosh, where to begin? I think the theme right now, being November, is it's dividend season. I'm watching all the companies, make their announcements of the dividend interest rate for next year. And the news continues to be positive. The companies, for the third year straight are now passing through this higher rate environment, which has always been the story of permanent life insurance, specifically dividend paying, participating whole life insurance from all these, major carriers that are still around after a couple hundred years. I actually spent a little time doing some research on my own, because I realized, all these companies were founded in the mid 1800s. And I was just like, what was happening in the mid 1800s that caused the formation of all these companies? And it was really pretty eye-opening. It wasn't stuff I necessarily didn't know, but there's this if you think about the time, it was a time in our country's history when we were moving west, the railroads were being built. And you think about how at that time, how dangerous that was, clearing woods and building roads, and OSHA was not a thing back then. It wasn't a very safe environment. So, people would leave their families for months or years, and there was no idea if they were coming home. So, these companies were kind of formed with this idea of almost like a commune, serving each other. And you hear these, story after story of, early claims being submitted, and, the founders of the company reaching into their personal pockets to make sure that claims were paid so that the company could move forward. And it was just reinvigorating to kind of go through all that. And I think that's on everyone's mind right now. There's been these, lawsuits in the news over IUL cases that were, they all had different reasons that they fell apart. And continues to be this narrative, as the market just won't go down, that, math-based, you can do better in the market than whole life insurance or IUL. And, these people are trying to scam you by buying these vehicles, which is also just so untrue. So there's a lot going on in that world that I've been seeing. And, I think this is the best environment to own whole life insurance relative to fixed income or other safe stuff in your portfolio. Probably in 4 or 5 generations. We're talking 80. It's been like 80 years since the deal's been this good relative to what else you can do with your so-called safe stuff. And that's just the message I continue to push. When I'm talking to anybody.
Yeah, Tom, can you unpack that a little bit more? And I know you've been on the channel and you've shared presentations, and so obviously those are things that we can reference back. But when you say that this is one of the best times in 5+ generations, like, unpack what you mean by that, and then unpack the difference between safe assets or your safe bucket versus your growth and risk, and how, Ernst and Young has said that together they can actually enhance, like, your growth and safe bucket can actually together produce a better outcome than just one or the other.
Yeah, so where that statement comes from, why this is the best environment in over 80 years, is everything is relative. So the truth is dividend interest rates are still relatively low historically. It's been about 50 years, since they've been this low. Just forgetting the last few years. So relatively speaking, they may still seem historically low, meaning, in the 80s, you were getting 13% dividends on some of these carriers at their peak. But everything is relative. So when you think about whole life as a fixed income alternative. Some people say whole life as a bond alternative. I actually really dislike the whole life as an asset class phrase because it's not an asset class. An asset class, it really defines like equities or bonds or real estate or things that can be bought and sold almost like as a security or like a security. Um, and are relatively liquid in that way. Like today, you can go sell it to a available open market. A life insurance contract, you don't sell to somebody else typically that way, and it's a contract with the company. There are levers inside that contract that the company controls. That said, the reason we say it is because if you look at the general investment accounts of all of these major mutuals and really all carriers, they are holding fixed income, long-term corporate bonds. They are statutorily required to hold assets of a certain credit quality. That's why they all have these AAA ratings or close to it, because you just can't kill them. They're sitting on tens or hundreds of billions of dollars. You really can't kill them. So, in a season like this, in dividend season, you got these companies paying, upper fives or all the way up to upper sixes, depending on the carrier. When you think about that relative to fixed income, meaning bonds, and for most investors, that means bond funds or bond ETFs or things that have a mark-to-market value that changes daily. When rates kind of hover at a low level or a spike, you see a lot of volatility. You also see relatively low returns, and you also see taxation on those asset classes. Whole life insurance kind of through the life insurance contract extracts all of that. Now, don't get me wrong, there's some significant upfront expenses, just like buying a house. I call them closing costs. It's like nobody buys a house and expects to move a year later and have made any money. There's a lot of transaction costs that go into that. But usually by year 3 or 4 in a home, you're starting to build equity and you've got a real property. So the same thing with permanent life insurance, that if there is a catch, assuming you're healthy enough to get it, that's the catch. But through the life insurance contract, they smooth out all of that volatility. Whole life is the only contract that guarantees your cash value must rise every single year. The only question is how fast. And that question of how fast is simply the rate at which the dividend is going to be paid. Technically, it's not guaranteed, but all these companies have been paying it since the mid 1800s. If you're going to get one, the question is really the rate at which you're going to get paid. So that dividend interest rate, why I think it's a great comparison to fixed income is that dividend interest rate is derived from the cash flow that the mutual carrier is getting in their general investment account. So when a company says they're paying a 6% dividend, they're telling you they're getting 6% cash flow from their investment portfolio. They're comfortable passing through to you as a policy owner. The difference is if interest rates spike tomorrow, let's say they double tomorrow because of some world event, bonds are going to suffer. Bonds suffered dramatically. We saw it in 2022. It shocked a lot of people that weren't really expecting it when you saw those kind of losses. You don't get volatility with whole life insurance. It just gets more valuable as that rising interest rate environment, averages into that dividend interest rate. So that's the key. Is it's not so much higher returns. Whole life insurance should give you corporate bond-like returns over time because the insurance companies are invested in corporate bond-like stuff. But through the contract itself, they've guaranteed that cash values must rise. They've guaranteed away all of the volatility. So once you're into a contract a ways, once you're a few years plus into a contract and you've kind of gotten past those so-called closing costs, now you're off to the races and you've got bond-like returns, but no chance of volatility as long as that company continues to honor its guarantees.
Well, and you have the death benefit, you have illness riders, you have some tax benefits if set up and used
Oh,
properly, that all are enhanced because of the contract. I was going to say because of the asset, but we'll change our language, because of the contract that you have with the insurance company. And when you add all of those and you get bond-like returns, it then becomes, do you have a problem with people calling it a better bond?
No, I mean, when I think of my personal planning, not that that has anything to do with any of our clients, is, I'm 100% equities, real estate, my own business, and then whole life. I don't own a single bond fund. I probably never will, um, because I'm going to have hundreds of thousands, maybe millions in whole life cash value that is today rising at over 5% net of all the mortality and expense. Like, why would I even consider bonds if I can get, a tax-free north of five?
Yeah.
Now I paid my dues. That's not my average return over time, but now that it's a mature policy and I'm adding to it, it's just going to get more and more valuable and move closer and closer to that over time. And I got it. You said it perfectly. All all of these pundits online that say it's a bad deal, they're focusing on cash value. But for most people, the real appropriate client for whole life insurance is not the family that's living on a family of four, with a five-figure income paycheck to paycheck.
Yeah.
These are people that are typically going, have real careers, have businesses, are making investments, and they will die with money. And there's no better place to have an asset transfer than through a permanent life insurance contract. So I call it the inevitable gain of whole life. I call it that death benefit. In fact, I coach my advisors that literally the only important number on that page is the internal rate of return on death benefit. Um, because who's going to cash out of their plan? Like who's going to just, I've never met a client that is just completely cashes out 10 years in unless they absolutely don't know what they own.
Yeah. Yeah, I had someone tell, like, I had someone kind of debate with me, and they were saying how, like, they were using some Limbra number to say how permanent life insurance, you know, a lot of it gets canceled and all. And I think there was a we are seeing the same number and maybe interpreting things a little bit differently. But it is true that there permanent policies, especially depending on what company you're working with and how it's designed, could give the entire industry a bad rap. But when you're working like in your mastermind, and I can speak personally, we have thousands of clients, and very few over the 10 plus years that we've been in business have canceled. And usually there's the most friction is in year 1 or 2. If people are properly educated, it's like, why would you cancel a contract that when you deposit money in, it's literally growing by more, and the death benefit is growing way more than what you're putting in. It gets to a point where it's like, it's it, why would you do that you're unless there's just another side of the coin, that there's people that are so like Venice, like, so anti life insurance that it's, I don't know. It's very interesting. I don't know if you have a take on, like,
Yeah.
obviously the Dave Ramseys of the world that, like, just hate on it, but then there's people that really, I believe, are trying to do right by people, and they just hate on insurance. And so it'll be interesting to see how those work out. But it leads me to whole life and IUL. But I want to just get your take on what I just said before, and then I want to talk about IUL and your take on that as a retirement supplement, as many people are calling it.
Well, there's two things I'd say. So the Limmer stats, you can make any argument with stats.
Mhm.
I would probably expect that. I would expect a lot of permanent life insurance, a lot of permanent life insurance policies probably get lapsed. I'll give you an example of mine. When I entered the business, when I first started as a life insurance agent right out of college, actually while still in college, I remember my dad saying, "Huh, never saw that coming. Oh, and by the way, I actually bought you a policy when you were 2 years old." And it was so small. I mean, I was like 21 years old, and I think the cash value was like $1,200, and like, you know,
Thanks, Dad. Yeah.
dollars. I'm like, so I cashed it out. So I think there's a lot of that goes on. Like that, it just wasn't a meaningful number in my life. And I also think that it's sold, frankly, by either unscrupulous or uneducated advisors to people that shouldn't be doing it. So buy term invest the difference is the best possible advice for those families I just mentioned. If you're living paycheck to paycheck and you're feeding a family of four on a five-figure income, yeah, buy some term, invest the difference, get out of debt, do all the stuff that these talking heads online are telling you to do. That's absolutely the right advice. But once you have had some reasonable success, or you have a career path where you expect to have the need to diversify and own a lot of different things, that's where permanent life insurance really gets exciting. So I think that's where a lot of the lapses happen too. Is it's not always predatory. I think most advisors are trying to do the right for clients. They just don't know, and life changes. You can get unemployed, or you can have things pop up and inopportune times. So I think that's where a lot of it comes from. It's not people that owned it for 15 years and they're earning six figures and now they're just like, this was stupid.
Yeah.
I've never seen that happen. Um, so I think that's one piece. And I forgot the other point I was going to react to, um, but I think that's the big driver of a lot of that.
When we did a series on the top 10 mutual companies out there, and one of the things that we shared is their lapse ratio in each, and
Yeah.
they were anywhere from like 2.5 to somewhere in like the top like 7%. And so the way I look at that is, and all the major mutuals were under 5, is the way I look at that is on all the policies that they have on their books, which is a lot. 2% are maybe churning a year kind of deal. Is that the way that you read that, or is lapse ratio different than, like, when companies share their lapse, is it just in the first couple of years, or is it, because the person that was talking to me was trying to make it sound like only 10% of permanent policies get paid out or something like that, and I'm just like, that's just not, we're talking about two separate planets. Maybe you could cherry pick some numbers at one company that's true. And I do believe that is a fear of IUL, is how many of the IUL contracts are actually going to pay out upon death. That means like people are going to have them, but like you can't tell me that these permanent policies only 10% pay out, and unless you know something I know, but they were almost like these insurance companies would fall on their face if they actually had to pay death claims, which makes a point to be like, you're saying that it's a scam, number one, but then you're saying that the insurance companies would go out of business if they had to fulfill on the promises. Like, you're almost indirectly saying that there is a benefit here, even though you're saying it's like, do you see how it's contradictory?
Well, that's just wrong. So I don't know about the 10% statistic or what actually pays out. I have to imagine it's way higher than that. But let me be clear. These massive institutions, these major insurance companies, they effectively have no risk on the books. Now, obviously they do, but when their general investment account, when they're holding, 2 or 300 billion dollars in reserve, that's effectively the present value of the claim that they expect to pay. So they're always fully capitalized. I mean, if nuclear war breaks out and yes, they lose 100,000 policy owners tomorrow, then yeah, that's a problem. But short of that, you can't kill these companies. I mean, they're holding the money in reserve. And even in the case of universal life contracts, which have a lot more risk, and that probably has a much higher lapse ratio because of underfunding or misunderstanding or the market doing bad things. Don't get me, the company got all of their dollars. Like on a year-to-year basis, they charge you a mortality charge based on your probability of dying that year. So, I mean, and COVID had almost no impact whatsoever on mortality for all these carriers, by the way. So, like, short of quite literally like a war where there's just millions of people dying across the globe, you really can't kill these companies. So I'm not sure where that comes from. That sounds like somebody with an axe to grind. That's just making statistics up. Um, you could say the same thing, that less than 2% of term policies ever pay out. Is it still a good idea to have the insurance, right? So for me, so a properly planned financial plan with permanent life insurance should have a 100% payout if it was sold appropriately
Yes,
to the right
agreed.
client who actually needs it.
I agree. And neither myself or you are endorsing getting an insurance policy and then canceling it 10, 15 years later. That would be really dumb. Just a public service announcement. Okay, let's talk about IUL, and it's interesting with the whole Kyle Busch deal. It's definitely made waves, and the other day we reacted. Dom and I reacted to a social media account that essentially like is calling in these IUL carriers with the client's permission and just drilling the customer service person. And the common theme was like, man, the customer service person did amazing, but it just, the whole situation sucked. Like, you could tell that the client was upset. This person was asking questions and kind of like baiting, and it was just like it's a disaster brewing. And I can just see that with this lawsuit, I believe that there's going to be more lawsuits to come. And now you're starting to see like a lot more people talk about how, especially IUL, is misrepresented. And then you have these multi-level marketing companies that are building up people that are just getting licensed, don't know anything, getting their friends and family, and then getting out. And that it's like a perfect storm, Tom. Talk to me about the difference between IUL and whole life. And we should maybe be charitable and say IUL done with a financial professional that's staying around, knows what they're doing. Like there's one thing, and then there's the everything else that's being sold. I know I threw like 15 questions at you in one, so why don't you just take the whole IUL and whole life and conversation when take it where you want to go.
Yeah, so I think I mean, there's a lot that goes into that. First of all, calling customer service and expecting them to have good answers on how this stuff works is inappropriate and it's unfair to the customer service person. These are typically entry level employees who, I mean, they're changing addresses and premium payments. They don't know how the inner workings of the actuarial science works. At the end of the day, on any life insurance plan, your customer service person is the agent who sold it to you, or it should be.
Could be.
And, this is definitely controversial in the space, but I'm all for insurance agents requiring more regulation or at least acting in a better standard than what's suitable at the time of sale. The truth is, in the insurance world, you can sell a life insurance policy. They buy the policy, they own a product, and you have no responsibility to ever call them ever again. And there's a lot of advisors that churn through, and you'll see them, the successful ones, you'll see them, 10 years into their career with 1,500 clients. You can't serve that many clients. Do annual reviews to make sure a universal life policy is working out, which is required to make sure that it works out. So that's the unfair part of, I think, the industry, is that advisors that are selling these plans, whole life or in universal life, have no requirement really, to stay on top of that with their client. And they're complicated. Even whole life insurance has complexities. You need an advisor who understands this stuff to hold your hand for the rest of your life. And if it's not going to be that advisor because they're in their 60s and they want to retire, there should be some continuity in there, for a junior advisor. So I think that's a big reason that the black eye is happening in this industry. Having been an advisor, years ago, you sell a policy and you're on to the next one. Even with the best of intentions, I always loved my clients and did the best for them, but I was paid to continue to push product. So that's an issue in the industry. Personally, I think that's a big part of it. That said, I've never understood IUL. I've never understood the attraction to it. I understand the psychology behind the selling of it. It's upside potential with downside protection. Who doesn't want that? I mean, that's just that sales pitch alone. Sure, tell me more. I want upside potential without the potential for loss. But the truth is, it's you have unlimited potential for loss. Yes, you have a year-to-year crediting guarantee, but the mortality and expense charges don't stop. Even if you get 0% in 1 year, the market loses 30%, but you're capped at 0% loss. That sounds so good. But you're still paying mortality and expense. It's a sub-zero return. You're losing money that year net, and then you got to dig out of it. And people always say, zero is your hero in an IUL, but I say the cap is the trap. Once you get behind that cap of 10%, 12, whatever the cap is, doesn't matter what it is.
The
It
cap
means,
that can be moved.
yeah, it
It can
means
be
that,
changed.
yeah. I mean, we live in the modern era. Every recovery in the market has been V-shaped. So even like the pandemic, we lost all that money in the market and it was back a few months later. In the case of an IUL, you don't get that 30% swing back up. You're capped. And if you actually do a historical analysis, you're shaving off a ton of upside to protect yourself against those relatively infrequent downsides. And when you understand, and we won't get into this on the podcast here, but unless you really want to, but if you understand the crediting method, like it's how the companies do it, they're buying a call option spread to get you a return in the market between 0 and 10%. They're not actually investing your money in the S&P 500 or whatever index is on that illustration. So if they're taking money from their general investment account, earning 5-ish% and buying a call option spread, in order for you to believe that IUL is going to outperform whole life over the long term, which effectively is getting that same 5% in the general investment account, you have to believe that call option spread is reliably going to get you 6 or 7 or more forever. And you don't think that the smartest minds on Wall Street, if they could find a predictable way to get 5% into 6 or 7, they wouldn't be leveraging trillions of dollars
Yeah.
and
Yeah.
borrowing every dollar they could from around the globe to do that. They're not. If you believe in even somewhat efficient markets, and you should in the age of AI, then your best case scenario in an IUL is what you're going to get in that whole life anyway, but without any of the guarantees long term. So to me, IUL makes no sense. It looks really good on a spreadsheet the same way VUL does when there's no volatility and you can just project something forever at static returns, but that's not real life. And a big part of what we do here is not trying to chase an extra 50 basis points on return. A lot of what we do is actually managing the behavior of our clients and building portfolios that work in any environment so that we can stay more fully invested because as the age old saying goes, timing the market doesn't work, but time in the market is what generates
That's right.
long-term compounding and results. So I want a policy that's guaranteed to go up in value, every single year so that I know that a piece of my portfolio is always rising. And even like the last week, we saw some volatility in the market. Earlier this year, we saw some. I don't think I turned on CNBC once because I don't care. I've got plenty of money invested in the market, but I don't care. I know that I've got a big piece of my portfolio rising. And that's the missing piece is it's not about rate of return. And that's what all the financial entertainment and all the people around their calculators try to back you into, but it's not a math problem. It's way bigger than that.
Yeah. What are your thoughts on people calling it retirement tax-free income? I yeah, I've been told probably 4 or 5 years ago, we just avoided showing income at all on a illustration. When I first got in, though, Tom, that was how I was trained, is like talk about this, all this stuff, do the pony dance show, and then be able to show the tax equivalent income, blah, blah, blah. And it was in whole life, but I regret doing that because I just am like, I'm projecting something out 30, 40 years on a it just didn't it there was something even inside of me that was just like, I don't know if I love this. But then we went away from it. We talked more about it as it well, I'll keep calling it an asset, but maybe as a contract, as a part of your portfolio and how it works and all these other things. But then I even watched some of the people, IUL people talking about the Kyle Busch and how they're dancing around it. And they're still using in the same video is like, well, the tax-free income and all this stuff. And I'm just like, guys, I think that is one of the biggest issues that is being used. And I think that's going to be when we talk about regulation. I see a world where people are not going to be able to project income, especially on IUL contracts. You can manipulate it to look so much better than it will actually happen. I do feel like it's somewhat criminal to be able to show someone income that's going to be like 3 to 4 times bigger than what it actually is going to be. And the fact of the matter is they can print it on paper with $1 billion insurance company's name on it, giving them a lot more credibility than their Excel spreadsheet.
Yeah. Well, I'll put it this way. If you could borrow money at 4% and put it in an asset that's growing at 6%, how much would you borrow?
100%.
As
All of it.
much as you could get your hands on, right?
Yeah.
So that's how those illustrations work. I have no problem with showing income. I mean, frankly, if I'm going to put tens of thousands of dollars per year into an asset, I'm going to want to see how the money comes out. And it's actually a really great conversation for clients. I mean, whole life insurance has unbelievable tax advantages. The first one that everyone forgets is first in, first out accounting. It's one of the few places where you can make money and the IRS doesn't tax you on those gains first. You can actually get your contributions back first. And then, through surrenders and loans, you can get many times what you paid in income tax free during your life. So I think that's a great story. But I think a lot of people are selling whole life insurance only for that. It's almost like, oh yeah, by the way, there's a death benefit too, but we don't really care about that. When in reality, that's for most successful clients. The clients that are going to retire with a 7-figure net worth, which sounds like a lot to people, but that's like the starting point to even be able to retire now. It's there will be a death benefit paid, and that death benefit is your permission to spend. That's knowing that my family, my loved ones, my kids, my spouse are taken care of. Then I can spend everything down. I can give my money away. I can die broke otherwise, knowing that my obligations, perceived or otherwise, are met in my mind. So that's the problem with the retirement income solves is it's a lazy sale. It's usually uneducated, or I say uneducated and unscrupulous. Sometimes there are the unscrupulous advisors that are just out to line their pocket. Um, that's just unfortunately the nature of the beast. And by the way, that's not unique to insurance. The investment world is the
Yeah.
exact same. Um, but I think a lot of times it's a lazy sale. It's they're afraid to talk about life insurance. They don't. It's a complex conversation because death benefit is only valuable if you understand it in relation to all of the other assets that you own, and it's hard for a new advisor who just started, and I should say new agent. They may not even be an advisor or have any other credentials aside from a life insurance license. That's a complicated discussion for them to have. So they kind of rely on these sales tracks, if you will, where they kind of just talk about, this is how the money goes in, this is how it comes out. How much would you
Yeah.
like? you know,
Tom, you're in a lot of rooms. You're friends with a lot of powerful people, especially in the life insurance space. Do you have any predictions on what we can expect for the near future and the future when it comes to just life insurance companies, mutual, whole life insurance, IUL? Like, do you feel like it's going to boom, or do you feel like there's going to be a lot of mass exodus of people getting out of the space? Do you think there's going to be more regulation? Do you think insurance companies are going to continue to get more attractive? What do you think is going to happen in the future?
if you're an advisor looking to accelerate the growth of your whole life sales, or if you're an advisor who has established themselves but is looking to get a little bit better at the conversations around whole life and serving some of the advanced markets, I have the event for you called the Fast Start Forum. My name is Tom Wall, and I have been in the business for 22 years, and I have watched advisors succeed at levels I never thought possible. The Fast Start Forum is coming up the third week of January, with arrivals on January 19th. This will be a room full of almost 400 advisors, thought leaders that write the white papers that a lot of us rely on for the data, performance coaches who work with top advisors and advisor teams. We'll share with you exactly the strategies that they're using with these clients, exactly the science and the data behind what we do, and language, actionable words and language that you can take to your clients to move clients to action. Because at the end of the day, this business is all about leadership and leading clients through the process so that they feel confident and powerful on the other side. The event is in South Florida in January, third week in January. It's called the Fast Start Forum. You can check it out at faststartforum.com. And there's no chance if you go that you don't walk away better and that the event pays for itself 10 times over. This will be an event where you can network with the best in the business, hear from the best in the business, and simply get better all in one place and make 2026 your best year ever. It's hard to say. All of these major carriers have stood the test of time. I mean, think about how much has happened in the last 175 years since most of them were founded. We've got major world wars, Great Depressions, just complete technological change. Everything has changed, and yet they still chug along. So I don't think that's going to stop. I think the biggest issue, and I think some of these headline lawsuits are going to create, and they're just beginning. Like the Kyle Busch lawsuit is the big news out there right now, but there will be more class action suits. There will be more to come, and I think that's a black eye for the industry because we know the difference. All the advisors know the difference, but the customer doesn't. They just see permanent life insurance. They see insurance scam. And all it does is it fuels these very loud voices with millions of followers online saying, "See what I mean? Like this stuff is all BS." And in reality, I know just working with some very big advisors around the country, I sometimes am on calls with their clients, and these are very successful. These are people that they work on Wall Street and manage funds that are buying whole life insurance, for a whole host of tax reasons and asset protection reasons. And you can't tell me that these smartest guys in the room, that work literally on Wall Street, are somehow stupid or being misled. So I think it's just a lot of it comes down to the quality of the advisor and the moral quality of the advisor to build the plans right. That's one of the things I love most about you and your team and what you do is you build contracts the right way. So they work no matter what, and you have conservative projections of what's going to happen, and you don't need the stars align for your plans to work.
Right.
They're going to work. It's just how well are they going to work, but they will work.
Yeah.
Whereas a lot of these illustrations look really good on paper, but so many things have to go right for that actually to play out that way. And it's not what insurance is for. It's called insurance. It's supposed to be rock solid. Go play elsewhere. It doesn't make any sense there.
Right. All right, Tom, you ready to look at this calculator that I'm working on? Okay, so just here's my disclaimer. This is not, we're not ready for the public. We're still working on some calculations here. One of the things, and you know who Todd Langford is. He has a calculator called the funding calculator. And when I first got into the space, it's funny. A lot of people are like, don't show IRR because it's a bad, like it doesn't, it makes life insurance maybe look smaller than it is because it's only one benefit. And I appreciate that mentality because life insurance as a contract is so much more valuable than the IRR that's in the policy. One of the things that Todd did is he showed the IRR and then he started factoring in other benefits. And then then he had an equivalent value that increased when you factor in those other benefits. And he was very clear, just like I'll be in this, that insurance doesn't get you 6 or 7%. But he's saying in an equivalent account, when you get all the benefits that you're getting in this contract, you'd have to earn X, Y, and Z for this. And so then when you start thinking about the safety of this, the even like we're working on right now, the risk adjusted return, because you're not taking on any risk in this contract. Whereas if you have to go maybe get something else, it would be probable that you'd have to take a little more risk. So when you start looking at this, life insurance is a pretty valuable thing. And so what I'll just let you in real time, like the policies that we design, we're getting anywhere from the internal rate of return around 4 to 5%. I don't know if you've seen things different, but what would you like to use as an IRR for just this example?
It's all about time horizon. But yeah, if you go out 20 years, then I think 4.5% is probably realistic based on what we're seeing.
Okay. So I'm gonna do 4.5%. And I don't know, again, this is like, do not be polite, Tom. I know you're East Coast, you're PhD. Beat the heck out of this thing, because this is not for me trying to be right. This is me transparently saying we're trying to create tools to get people to think differently. And so below, I looked out over the 30-year high yield savings account, and over the last 30 years, the average high yield savings account earned 2.5%. So we're in a higher yield, but we have to remember that, you know, there was a day that you'd be lucky if you got 0.5% in a high yield savings account. So right now, over a long period of time, a life insurance policy, the internal rate of return, not doing anything, just looking at the rate of return is going to compete or outcompete a high yield savings account. I have the 30-year aggregate bond index at earning 4.75%. Do you think that's low? Do you think that's high? I just literally took the middle of when I did research. I just took the middle, and obviously bonds are earning greater than 4.5% internal rate of return. What would you put as the bond if you had to look back on just 30 years, the average bond return that you would bank on?
I don't even think you need to do that. I mean, the expected return of a bond is effectively the coupon rate right now. So if you're looking at 30-year bonds, I'd use that. So 4.5, 5% seems totally appropriate.
Okay. Okay. So you can see right now, you can even make the argument when we talk about life insurance and all the benefits on how it's right there up there with bonds. But now what we'll do is we'll start factoring in some of these other things like taxes, management fees, cost of insurance. If we want to really get crazy, we can add an equivalent to an illness rider, which could be, some people could talk as like a long-term care hybrid. We could choose not to do this. In some states, creditor protection is really good in life insurance, and so sometimes we could factor this in. And then we're working on the risk adjusted return as well, and I'll explain that. So from a tax perspective, obviously, if we're comparing this to a savings account or checking account, we could look at ordinary income tax. If you're comparing this to bonds, that may not be fair. And so what would you like to use is just an alternative tax rate? I know you're talking to very wealthy people in states that have high state tax as well, but what would you like to use from a tax rate, Tom, in this example?
So the tax rate you should use is at the margin, because this is not going to be your entire plan. So some people will focus on effective tax rates of 15 or 20%, but in reality, you probably should be using 24 to 40%. I live in Massachusetts, a high tax state, not the highest though. You live in like California, wealthy people are paying over half in taxes. So it doesn't really matter, but I think to be fair, 30% or something like that, I
Okay.
think It
And
makes
and the
sense.
reason you're saying that is because if you eliminate tax, you have to give them the benefit of the highest tax bracket. And so I agree with that. So we'll just say 30%. Now, what this does is now it puts an equivalent return. Again, I want to be very clear that this is not life insurance is not getting you 6.4%. What I am saying is if over a long period of time, if you're showing an internal rate of return of 4.5, and then you're factoring in that you're not having to pay tax on that, in an equivalent account, you would have to earn 6.4% just to keep up with this whole life insurance policy. Now, the cost of insurance is another interesting thing. If you run just 30-year examples like buy term and invest the difference, and you run what we did is we ran lots of different examples of what whole life would buy you permanent insurance wise, and then we would say how much of that premium would we have to take to buy the equivalent of term over 30 years each year essentially, and that was around 10%, 10 to 15%. But then you have to factor in that term death benefit expires, and most of the time it won't pay out. So we could use let's just say 12% as the equivalent to 30-year term. But if you want life insurance till 85, or looking at like guaranteed universal life, or like a guaranteed universal life policy, which is you're essentially not getting any cash value, you're just getting pure permanent death benefit, you're looking at anywhere from 30 to 40%, Tom. Whereas, you know, if the death benefit was really, if you educated your client on the importance of a death benefit from an estate tax purpose, it would be very reasonable to say that if you factor out over age 85, which, oh, by the way, life insurance only gets better over time, that you would anywhere from 10 to 40% we would factor in for cost of insurance. And what we're essentially doing is now you'd have to earn over 10% every single year. Why don't you beat this up? Do you have any questions on what I'm doing with the cost of insurance?
Yeah, I don't quite agree with that part. So when I look
Okay.
at cost of insurance, that cash IRR 4.5% or whatever it is net of mortality and expenses. So that's
Correct.
effectively what's actually showing up in your cash value. So my assumption is that this cost of insurance is to compare it to what you would be paying elsewhere for
Yes.
insurance. So if you think about the alternative of that $1 million whole life policy being $1 million term policy, in my experience, it all depends on how the whole life is built, but it's probably about, 1/15, or, call it 8%, 7 or 8% of the total premium that you're paying. So yeah, you're saving money on owning term insurance separately. But I think sometimes that gets overstated, because
Well, let's unpack this. What I'm doing is let's say you said 1/15th, and we should run some of the numbers, because I maybe the way that we're designing it, maybe with overfunding and all, it's more around 10%. What I'm saying is if we're assuming that you're going to buy term, that money's got to come from somewhere. And if you purchase permanent policy, we're not in this assumption, we're not assuming you buy term insurance. And so it's 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 reasonable to say that you would have to earn more if you're factoring in term insurance in one scenario and not in the other.
that's right. Yeah.
And so all this would be, and what we could also do is work on net numbers. So we're using just percentages, which can be tough. We could easily show like a $20,000 premium, and then show like, okay, that's actually what Todd's calculator does. But then you have to run all the numbers, and this is like a back of the napkin deal. So, are you cool with us just using 10%?
Sure. Yeah.
Okay. Do you have a follow-up question? Because all I did with the 30% is saying if you looked at like a guaranteed universal life, what that would cost from a percentage of your whole life premium, which is still not going to be close to 100% because whole life builds cash value in others, but it would be a lot more than 10%.
Right. Yeah.
Okay. Now, the fee, this is something that some people don't want to factor fees at all. If you're looking at any type of portfolio management and all, like you could put 1%, we could put lower, we could put higher. This is just an equivalent of like, we're now talking about, again, buy term, invest the difference. You have your alternative portfolio and all. Again, what I'm not saying is that life insurance gets anywhere near 8%. I'm just saying when you factor in this example, a 30% tax, a 1% fee, and then you assume that you could buy term insurance for the next 30 years for 1/10 the cost,
Hmm.
you would have to earn in a side account 8.3% every single year. And we still have not factored in the illness rider and creditor protection. And we won't do this in this video because these are really tough. I'm still working on like the proper way to factor this in. Um, but but then in addition, Tom, I'm working on figuring out the risk adjusted because life insurance, to get this 4.5%, you're really not taking on risk. You may not get to that internal rate of return because we're dealing with non-guarantees here, but you're not taking on risk that you're going to like just lose your money in a market volatility. And so
Yeah.
there's got to be some, if you were comparing to say like 8 or 9%, you would have to, there would be some assumption that you would have to take on some additional risks in the life insurance. And that might not be a lot, but that needs to be factored into this equation. Um, I know this is the first time you're seeing this. When we first hopped on, I said I'll throw something at you. So again, in real time, what are your thoughts on even using a tool like this to not tell people that life insurance is going to get you 8%, but start elevating? Because Todd's whole deal is everyone's trashing life insurance, life insurance, life insurance. But when you start just educating some of the other benefits that this contract does for you, you start realizing that the rate of return, it's not an investment at all. We should never compare it to an investment. But all the benefits and jobs that it does for your dollar, it actually is a really solid performing contract that should be looked at very positively when it comes to your portfolio.
Yeah. I'll give you two thoughts. So I think you nailed it. When I think about the IRR and cash value, there's three things that enhances it. Is A, it's tax free to a degree because technically, if you cashed in the policy, you would pay taxes on gains. So the way you access those dollars is important. But that IRR on cash value is really understated because you're right. In a taxable world, what are you going to pay in taxes? There's definitely people that say, well, I can get long-term capital gains at 15% if I just hold my stocks for a year. Stop right there. We're not comparing this to stocks. So I love that you actually compared this to, high yield savings or bonds because that's what it should be compared to. Somebody with just a 100% appetite for stocks and risk, that sure, that's maybe this isn't for them. In management fees, you can knock down to 0.5%, or you can make it darn near free if someone's index fund investing. Um, Cost of insurance, you could say maybe it's 1/20th. You could it's 5%. So bump the tax rate down to 15%. Let's just say let's just be as fair as we possibly like over the top fair. That's a very realistic. So where else in the world today, in today's world, are you getting 6% with no volatility and no market risk? Like it's just not going to happen. And the thing I like about, and that's a good comparison today because, whole life insurance dividends are roughly what you can get on a long-term corporate debt anyway. So they're kind of they're almost at parity. So the illustrations are relatively fair the way you're running it right here. But I'll give you a different framework. I'm actually working on a white paper right now. So this is going to be broadcasted, but don't tell anybody. Uh,
Okay.
the way I like to think about it and the way I'm going to couch it is economists talk in terms of expected return. So I'll give you an example. Let's say you have a 50-50 portfolio of stocks and bonds. You expect your stocks to get 8%, you expect your bonds to get 4%. So the way expected returns works is we take 50% times 8, that's 4, and 50% times 4, the bonds, that's 2. 2 plus 4 is 6. My expected return on that portfolio is 6%. Make sense?
Yes.
Uh, if you think about that in terms of life insurance, there is a death benefit that never gets recognized. There is a chronic illness rider that doesn't get recognized. There is creditor protection, hypothetically, but I won't go that far. But what I want to do is I want to take a life insurance illustration, and even if the IRR and cash value is only, say, 3% at that time, there is a chance in that 10-year period of time, or 15-year period of time that I died. So in year one, I want to look at my expected return. Maybe it's 0.1% times the $1 million death benefit plus 99.9% cash value. And my expected value of the policy, when you combine the chance that I die or chance that I use it while I'm alive, is more appropriate, and it'll always give you a more accurate representation of what it means for your economic picture, thinking like an economist in expected value. And that's my attempt to help the industry think about all of the benefits. And if you fast forward 30, 40 years, you could factor in the chance that that year you have a long-term care claim costing $100,000 per year. What is the value of that benefit being on the contract? So that would be version 2.0 or 3.0 or whatever. But I think that's how I think about life insurance and the economic value of it.
When it comes out, let's have you on the show to promote the white paper and maybe you can walk through it. Because a lot of times people are just valuing the cash value and the increase of cash value and the internal rate of return. And the death benefit is one of those just like side elements. But what you're saying is not that anyone wants to die early, but if hypothetically you were to die in the first couple of years, the IRR on the death claim is insane.
Like a
And so
thousand
that
percent.
needs to be factored in to your overall economic decision when you're thinking about your holistic balance sheet. Hey guys, I just wanted to interrupt real quick. If you're watching this and have an index universal life policy, a whole life policy, have any type of insurance policy in general, and you're like, I want to know if I'm on the right track. I want to know if this is set up properly. We at BetterWealth want to help you. We want to give you a free policy analysis and show you, are you on the right track? Is there some things that you potentially could be doing better? And so we have a link down below that you will have access to. We would encourage you, if you have a policy and you want to see if you're on the right track, check that out. And if you're someone that's watching this and you're like, I want to talk to someone maybe setting up a policy for myself, or I have questions, we would love to serve you. You can also see a link to have a call with someone on our team. Back to the episode.
Yeah, so I think it's great. I think this is helpful. I mean, people need to think about all the other stuff. It's not just it's not just rate of return versus rate of return. There's so much more that goes to it. And any discussion of IRRs and cash value totally cheapens the contract by not recognizing all of the other impacts at play.
Yeah. And you even look at this conservative, if we take a 15% tax, 0.5 management fee, and 5% cost of insurance, we're not looking at chronic illness rider, we're not looking at credit, we're not factoring in all the other benefits that life insurance as a contract still gives you. Like, you can't really factor in safety into this whole thing. But it still is it's more attractive just from an equivalent return standpoint than what someone would be expecting bonds. And so it is again, this is just a tool in production, but I want to create more tools that just get people to think differently. But the problem with this is, in the hands of people that are not ethical, you can. This is my challenge, Tom. Is like you create things to help people, like, and you probably get this too. Is like people that you would not endorse, that might be promoting something that you hate, but using your name and your book and your research. And so it's kind of a double-edged sword. I know that there are people that use my book and these videos to push their own agenda, but I feel like we just need to fight it with more information, more speech, and not try to go after people or shut people down. That's just my take. I don't know how you manage that when people twist your words.
There's two things that come into play. I mean, any comparison, to be fair, you have to look at risk. What are you comparing the asset to, but also timing. So
Yeah.
whole life is a really bad deal if you're using it for 2 years to save up for a house and then cash out. Like, that's not a good deal. The deal gets better every year that you own it.
Yeah.
So it needs to be a long time frame. So the struggle I had when I was writing my dissertation on whole life as a fixed income alternative was timing. In the early years, it's a front-loaded fee structure as opposed to the investment world where you're paying a flat fee of 0.5% to 1% every single year forever. In fact, you typically, if your assets are being managed professionally, you're typically over the course of your life paying far more in investment management fees than you are to any life insurance contract. No one talks about that either. And you can also make adjustments on the other side too. Like, you could just look without any thoughts and look at the S&P 500 and say, over time you average 12.5%, which you actually did, arithmetic average. But when you factor in geometric returns and what you're actually paying in taxes and fees, most smart financial advisors are going to put you in the 7 to 9% range at best, because of all those forces. So I think what you're doing is great to, on the other side, boost up the value of whole life insurance, at least in the eyes of the clients.
Tom, you got an event coming up That is, I'm going. I'm actually sponsoring. I'm excited to be a part and just support what you're up to. Talk to us about how people can get involved and some of the things going on.
I'm really excited about this. So, if you don't know who I am, so I've for the last 4 years, really my whole career, I've been on stages talking to advisors. But about 4 years ago, I decided to go out on my own, outside of the employment of any of the major mutuals, and I'm in a different city every week. And it's grown to almost two a week, where I'm in different places around the country speaking to advisor audiences, talking about how whole life insurance works, where it fits in financial planning, how to confidently talk to your clients about it, and connecting these advisors with top 1% advisors, some of the thought leaders in our space that write the white papers and consult for major institutions. And I've just been blessed in all my travels to just know all these people, and have become connected. So I created a group called Whole Life Masterminds, which is hard to believe, but it's grown to 1,600 active users today, and it continues to grow. I don't think we're even close to done growing. And it grew to a point where at the beginning of this year, I said, let's do a live event. I think the world is kind of zoomed out, and they would love to just get together and network and hear live. The other thing I noticed in my career is all of these events are very expensive. I can tell you, running an event myself, it is extremely expensive. So what happens to these events is you get sponsors. There's plenty of companies that want to be involved, but they also want stage time. So you go to these conferences, and half the time it's someone trying to sell you software, or some company just launched a new annuity with this rider that saves you 10 basis points. It's silly stuff, but that's how they pay for the events. And I just wanted to create an event where there was 2 full days of just people practicing this stuff, people studying this stuff, coaches coaching top advisors, giving you all of their best information with nobody else on stage with any agenda. And I think the response to my first event was tremendous because of that. And it was such a great response. We're doubling the size. So we're going to have over 400 advisors in South Florida. We're taking over the Hard Rock Seminole Hotel in Hollywood, Florida, right outside Fort Lauderdale. I think we're 9 weeks out today, and we have over 300 committed to go, and they just keep rolling in. I'm watching my phone actually blow up right now with people buying tickets. It's going to be a huge event, and it's first class all the way. So we've got Michael Phelps as our keynote speaker. I've got, company number ones on stage, so top advisors from companies. I've got some of the thought leaders that grace the stages of the biggest events in the industry, that I've just curated myself to make sure that the content is as high level as possible from people that are actually doing it day to day. So, if you're in the insurance space, and you want like the event to go to really just make yourself better, surround yourself by other folks who are trying to get better. And it's not a room full of newbies either. I mean, these are typically people that have been in the business for several years and have, proven they're not going to fail. Some of them are actually, multi-million-dollar advisors who are still going, to sharpen the saw. This is the event you want to be at, and it's at the perfect time of year. It's the third week. It's called the Fast Start Forum as a nod to let's get off to a fast start this year, with all the tools and resources and ideas that you need. Let's also go to Florida, because where else would you want to be in January in the United States? So it's going to be sunny, and you can wear shorts, and it's going to be a casual environment, so you can hang out and get away from the cold weather that the rest of the world has. I live in Boston, so I can tell you I will be itching to get out of Boston in January anywhere I can go. And that's it. I'm kind of pinching myself. I find myself at the middle of all of these amazing people in the business. I continue to learn every day from them, and I share my wisdom and what I've learned along the way back. And it's been a great environment. And I hope to be able to continue to do this for the foreseeable future.
So if you're watching this and this resonates, get your tickets. We'll make sure the link is somewhere down below. I'll be there. So if we've not met, I would love to meet you. I'm not only going there, but we're sponsoring. Just as Tom, you're an amazing life giver to our industry and profession, and I just am excited to see this thing grow and be a part of it. So, anyways, check out information below. And Tom, thank you so much for coming on your busy schedule to just jam on all the fun and exciting things that we talked about today. Appreciate you a ton.
Yeah, appreciate you. And if you want to just check it out right now, it's faststartforum.com. You can check it out. You can buy tickets right there. And we're not sold out yet, but by the time this airs, we may be getting close, and we will get even close. I think the first thing that will sell out is hotel rooms. So hotel rooms, as you can imagine, in South Florida are not the cheapest in January, but we were able to lock in a pretty great rate way back in March. So, so yeah, hop on that now if you're thinking about it. And if you have any questions, you can always reach out to my team at info@wholelifemasterminds.com and we'll get you whatever you want.
All right. Thank you so much, Tom.
Thank you, Kiro.